Don't forget, you can reach the latest episode of Potomac Watch anytime. Just ask your smart speaker, play the Opinion Potomac Watch podcast. That is, play the Opinion Potomac Watch podcast.
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Paul Gigot here on Potomac Watch with my colleague, Joe Sternberg. Joe writes about monetary policy and economic policy for us and for his political economics column for the Journal. A couple of things happening this week, Joe. The Fed is tipped by many to be poised to raise interest rates again by 25 basis points. They paused in June from their year-long path of raising rates from near zero up to 5 to 5.25. The suggestion now is the markets are certainly building in to their expectations another quarter point here this coming week, and probably another quarter point before the end of the year. And that's despite the fact that inflation has fallen from a peak of 9.1% in June of 2022 down to 3%. 3%, the Consumer Price Index in the last report in June for 2023. Now, core inflation, that's without food and energy, is still sticky at 4.8%. Services are rising fast, the prices, particularly for shelter. But is it safe for the Fed, Joe, to kind of get out of the interest rate raising business here for an even longer period of time? Or do you think that it's best to move now with 25 basis points, which by itself will not tip the economy into any kind of recession? It's more a signal about direction.
Well, I think that it's helpful for the Fed if they want to find ways that they can signal that they are not resting on their laurels and they are not going to assume that inflation is on a downward glide path. So one way that they can signal that would be with the quarter point rate increase. And I think that they also presumably are going to be alert to the fact that although the inflation rate is coming down, it is certainly not really, it appears close to their target, their 2% target, only because they were so wildly off the 2% target over the past year that inflation where it is right now looks like a serious issue. But remember, if we had been having this conversation back in 2020, we would have thought that inflation at its current level was signaling that the Fed was not doing its job of keeping the rate of price increases at 2%. But I think that they are going to run into a growing set of problems understanding what their next move should be, because so many of the economic signals that they are looking to for guidance about what they should do are conflicting. So, you have headlines about house prices seem to be going up a bit again. Inflation is moderating, and yet the labor market, which the Fed believes is very important as an indicator of what inflation will do in the future, still is much stronger than the Fed would probably hope that it would be. And so I think that really what's happening is that we're going into a period where they are going to have a harder and harder time figuring out, just on the basis of their own model and an understanding of the economy, of what they need to be doing at each meeting.
You mentioned conflicting economic signals. Boy, say that again. I mean, we have bond prices are still low. I'm talking about government bonds, the 10-year, the longer term bonds. 10 years is still at 3.8%. And the yield curve, which measures bond rates across the duration, the term of duration from treasuries all the way up to the 30-year, that's inverted, which is often a sign of recession, Joe. It's been inverted for quite some time. Also, you see consumer sentiment has popped back some, but the leading economic indicators have been down for almost 18 months as well. And that doesn't bode well for growth. On the other hand, almost every economist expects some growth in the second quarter here. Atlanta Federal Reserve GDP Now figure is predicting 2.4%. Most people are predicting something like 2%. That's not a recession. I mean, it's not gangbusters, but it's not a recession. It would follow this first quarter's 2%. So the signals here are hard to decipher. I mean, this is one of the more difficult periods where I've been, for myself, just in looking at the economy and trying to get a sense of where it might be going. And Joe, coming across my desk this morning is analysis and summary of the economy by Ed Hyman, who's one of the the best forecasters on Wall Street. And he's still signaling there's going to be recession starting in the fourth quarter and extending into the first half of next year because he's a monetarist and he sees the money supply is contracting and operating with a long leg of 18 months. So he figures that if the Fed started raising rates in the spring of 2022, we'll be right on time for a slowdown in the fall of this year.
I mean, it's an example of how it's hard I mean, not only are all of these signals conflicting, but it's then difficult, doubly so to understand which of these many conflicting signals are actually the important ones. And so I think that this sort of issue about, the money supply and what that is telling us about the demand for credit and the supply of credit in the economy, I mean, I think that is a very serious signal that is worth paying attention to, even if I wouldn't necessarily call myself a monetarist. I don't think you can ignore any of those signals outright. And I think that one of the things that worries me about the Fed and their approach to policymaking is that they have what I would consider a very pinched view of how the economy works. They think that there are very mechanical relationships between the labor market and between the growth of the economy and, the inflation rate. And so they're operating on very pinched model that means that they aren't necessarily taking account of some of these other factors. I mean, certainly developments in the money supply would be one of those factors. I think that they also need to take account of the potential that we could still have a lot of uncertainty or instability in the financial system. I mean, if you consider how low interest rates were for such a long time and how rapidly rates have risen, I mean, this might just be the natural pessimist in me, but I find it hard to believe that something like Silicon Valley Bank is going to be the last episode of disruption that we will have as a result of this process of rates rising. And yet you can't say exactly where the next threat will come from.
Yeah, I agree with that. I think it's way too early to declare victory in this inflation cycle. Also, in the consequences of the rate increases and what impact they'll ultimately have on the economy and on the financial industry. Because when you do have rates rise as rapidly as they have, you tend to see cracks form, and that could create bigger problems. One other point to make economically that I think is worth watching here in the next few weeks is the return of militant labor, if you will. The United Auto Workers are negotiating contracts, talking very, very tough about their willingness to go on strike if they have to get a fair contract. All of you are watching, of course, the Hollywood strike, writers and the SAG-AFTRA workers on strike. That's about 160,000 workers, pretty big industry in the United States. And they're already out on strike. And then you have the Teamsters, their contract with United Parcel Service ends on July 31st. If they don't get a new contract, they have vowed to go on strike. And that's 340,000 workers. And those workers are central to the growth of the economy for supply chains and so on. And the Fed will have to think about that impact for economic growth and obviously for the impact on inflation of any major wage increases across the economy. All right. Thank you for listening today, folks. Thanks to Joe Sternberg for being on here. And we are back every day on Potomac Watch with our Fearless podcast. And we really do appreciate you being here. Thanks for listening.